All right, founders, welcome back. We are here for segment 2. Joining us today, Nail the Numbers Pro, Dustin Bosch, who is also the Vice President of Sales for Canadian Equipment Financing. And this segment, we're going to keep it short and sweet, but there's definitely some numbers to be crunched if you are looking to either purchase new equipment, because I know across the board right now, I've been seeing lots of different things when it comes to business owners through COVID. There are some that are having a hard time keeping up with demand, and there are others that are really just looking to get extremely lean, extremely mean, extremely efficient with respect to the equipment and the fleet that they currently have. So, like every purchase, there are hidden costs that we don't always take into consideration. And Dustin, I'm hoping that in this segment, you can shed some light on what we really should be looking at, what founders should be looking at when they're looking to, to not only assess whether to buy a new piece of equipment or not, but really, again, creating efficiencies with the equipment that they have. So I know we wanted to talk a little bit about amortization, depreciation, and maybe we can jump to that in a moment, but what are some of the miscellaneous costs that you are finding founders really have their blinders on when it comes to, I never even thought about that?
Right up front, whether they're buying new equipment or used equipment, there's always some modifications or changes that are needed to fit the application that they're doing. I've just found that entrepreneurs will have a budget in mind. They say, okay, $100,000 is the piece of equipment that I want to buy, but they're forgetting about the $15,000 to $20,000 of extras that they're going to have to add on to the excavator for guarding, or the truck wet kit so that it can pull a trailer or something like that, right? And they often get overlooked, but they add up quick.
No doubt. I'm thinking in my experience, I see things like licensing for each piece of equipment, insurance, maintenance, tires, any sort of training that goes along with it, the travel that goes along with the training sometimes, depending on where the manufacturer is. Any like oddball scenarios that have come up for you that just kind of threw an entrepreneur out of left field?
Yeah, you've covered a lot of them. Those ancillary costs are they're needed. You can't get around it. Commercial vehicle inspections are another little thing that pop up from time to time, and then there's all the the hidden repairs that you were never aware of that you have to do in order to get the vehicle on the road, for instance. The big thing that's often overlooked as well is what downtime can create with equipment. It's probably a conversation that leading down a different path, but there's major.
Maybe expand on that a little bit. What do you mean by the downtime created by each piece of equipment?
Well, we often think of like the inherent costs that we have to pay out to do something to get that equipment. So we've covered a lot of them here just over the last minute or so. But it's a different thing when the equipment's running and then all of a sudden it breaks down and now you're losing revenue on a daily basis because you're waiting for a part to come in or a mechanic to come out and fix it. So often the bigger cost associated to owning equipment is the potential downtime that it can create for you. It's hard to quantify that number up front, but I know dealing with customers and clients over the years, the downtime itself can often create a big enough issue that it would have been better for them to just rent the equipment rather than own it.
But yeah, Dustin, I think that's huge. I think that's really important for founders to hear. And I'm wondering, do you think there would be value when they're looking to purchase a piece of equipment? Is that something that you think a manufacturer might be able to answer, just with respect to a high level benchmark? Here's what we've seen in the past from our clients. I'm trying to figure out where they'd get that info from.
Yeah, absolutely. And I think a lot of individuals in the industry understand that relatively well because, for instance, they look at the parts and service network that a dealer would have, right? Caterpillar equipment is number one in heavy construction for a reason, because not only has it carried a good brand, for instance, through the years and good resale value on the back end, but if something goes wrong with their equipment, they're generally fairly quick to respond because they have a network of mechanics or field mechanics out there that can respond to it quickly. So, looking to purchase a piece of equipment, sometimes that has a big implication on whether I buy an off-brand unit or an in-brand one, is what we would call it.
Beautiful. Well, I think what you've really stumbled onto here, I think, is the conversation or the planning process. A lot of founders of potentially smaller based businesses, right? Those that are up to 5-20 million, that maybe aren't thinking about this. When everything's good, everybody's kind of resting easy, but this might be the time to actually start figuring out what is your backup plan, right? To kind of mitigate that downtime if it should come up, so you can move into plan B right away. So that's huge. Thanks for sharing that, because I wouldn't have even thought to calculate that downtime on each piece of equipment. So super important. One question that I oftentimes get from founders is amortization costs. They see it on their statements and they don't see the money going anywhere, but they see this write-off. Hopefully they're looking every month, but let's just say at year end, when they're looking at their notice to readers and they're seeing this, this huge expense of amortization or depreciation on their asset. Can you speak a little bit to that and the impact of that to them as a founder?
Yeah, absolutely. It's a bit of a black hole for sure for a lot of founders and entrepreneurs, because it's what we call a non-cash item. It's an accounting adjustment, if you will. It's never money that they see leave the company. So they're like, well, why is it shown as an expense on my income statement? And what it is it's just an accounting adjustment to offset the depreciation of the asset that's shown on the balance sheet. So amortization only comes into play if you've purchased equipment or an asset, right? And that asset is then recorded on the balance sheet as such. And like every asset, they depreciate over time and they have to account for that. So every asset will have maybe a different depreciation rate. So how quickly it gets depreciated, but they have to account for it. They have to adjust for it. And that's why they see it. And it always gets basically shown at year end, not throughout the year.
And so it's my understanding that there's typically two forms of depreciation, right, that accountants can use. And I think this, to me, or at least in, my experience, this is where I like to ask the founder again, what is your end game in this and when are you looking to get out? Because one, I believe, accelerates the depreciation rate, right? So you're paying less tax or less taxes. It's impacting your tax consequences at the end of those years as the depreciation is accelerated, but it's giving you less of a value of that asset within a shorter window, right? So anything, do you have any experience with that, or any questions that you think founders should be asking accountants?
Well, you know what, I've often found that, again, a lot of it comes down to the application and use of the equipment. So like in the forestry industry, if it's the application being tougher and if it's being used a lot, then they depreciate the asset fairly rapidly to keep up with the devaluating value of the equipment itself, right? But you're right. So depreciation is an expense. It reduces your net income or your bottom line, and that's what tax is calculated off of. So I think understanding the useful life of the equipment and how long you're actually going to keep it within your fleet will help you determine with your accountant what is the appropriate depreciation rate, because there's a fine line there, obviously, about not wanting to pay tax if you don't have to, but also keeping the equity on the balance sheet so that it looks like, or it is, you're building a net worth within your company like you would any other or like you would try with any other investment.
Yeah, the value of it. And so as you're talking here, I was just thinking about, when we opened up this episode, we were talking about all the different companies that, or industries that have equipment. I'm thinking professional services right off the top. And there's useful life value of the equipment. And then what came to mind for me is also technology, right? And so with some of these professional services, a piece of equipment with technology, you could use it for 20 years, but the technology might just become so limited within 3 that, understanding that you'd probably want to replace it or do an upgrade within that time frame and taking that.
Absolutely. We see that with municipal finance a lot. For instance, the telephone systems and the back end IT infrastructure, like the technology is changing so rapidly that it never makes sense anymore to hold that stuff for 10 years when in 3 to 4 it's becoming more obsolete and there's new stuff coming in all the time. So to try to carry it that long and then obviously fight with the issues that you would need to with their IT departments to try to keep it salvaged and up to speed for the growth or whatever that they're trying to handle, it becomes a black hole, or a rabbit hole for that matter.
Right. Yeah, and that's a good point too. I mean, we're putting out lots of suggestions there for everybody listening to this, and I know that sometimes it can feel overwhelming with respect to everything that you need to do. And I know we're just talking about equipment here right now. I know one of the best practices that I love to implement with founders is your, financially fierce Fridays, where you sit down and at least for an hour that day, you just, you start looking and drilling down into the numbers and, just create efficiencies, right? It's not about perfection. It's just about progress. Just take it a step at a time and do something as it pertains to your numbers there. So what I'm hearing as takeaways from this, Dustin, is get really clear on all of the costs that get attached to each piece of equipment. And do we want to talk at all about the return on investment? I guess I know you had mentioned that's not something necessarily lenders look for, but I think for founders, you do want to know that, is that piece of equipment actually making you money? So taking a look at the revenue that you're generating from that piece of equipment, and then not only the costs on the equipment, but I would factor in all the costs attached to that piece of equipment too, including your interest and all those other good things that we talked about. So any takeaways on this one, Dustin? What I'm hearing is just know the costs, calculate it out, speak to the accountant about amortization, depreciation, getting the accountant to understand or walk you through the method that they've used and the impact that that's going to have in your business, short-term, long-term. Any other key messages that you want to leave founders with?
Well, it's a decision about how they use their cash at the end of the day, right? So I think decisions like that always have to be rooted in understanding the cost, to your point, Tanya, but it's a weighing of options. So if I use my cash to buy equipment, is that going to return as good or better of an investment for me? So return more cash to me as if I were to use my cash elsewhere in the operation. So forego the equipment purchase and put it into HR or, operational improvements within the manufacturing shop or something like that, right? So I think that's the decision that always needs to be weighed is the equipment might not be the right piece. It may return, 50 cents on the dollar, where I could do something else that would return, $1.20 on my dollar, right?
Yeah, I think that's huge, Dustin. I think for everybody listening here, this is where you go back to the first episode too, and you understand the utilization and, what is happening with this piece of equipment. Are you making money on it? And are there alternative ways that you could make money on it? Do you lease it out, right? And
That's
not
right.
have to incur all of those expenses, and or bring in a subcontractor to do that work, where you just get a lift on the work that they do and not have all of those costs. So thanks for that, Dustin. For people that are listening and watching, again, if you look in the show notes below, you're going to find some tools that you can download. One is an equipment cost calculator. It puts in high level some of the extra costs that we talked about, including the interest that you're carrying on these pieces of equipment, as well as maintenance and licensing, so that you actually really truly see the carrying costs every month. And that might light a fire under your butt to get some revenue attached to that piece of equipment, and or maybe let go of it, right, Dustin? We didn't even talk about letting go of equipment, but sometimes that needs to happen.
Oh, absolutely. Yeah, I know that well.
I've seen it in a few models too. All right, this is it for segment 2. Please join us for our next segment, where we actually start talking about return on investment on your equipment. And Dustin's going to share with us his perspective as a lender and a financier in this space to let us know what he and his colleagues would be looking for if you're ever looking for money to buy new equipment. So as always, thanks for watching. Don't forget to download your tools and templates down below, and we'll see you back here for episode